Good morning, good afternoon, good evening. Thank you for joining this webinar. My name is Ankit and I'm the co-founder of BIGGR Financial. BIGGR is a platform of India's leading SEBI registered investment and financial advisors who can assist you with your investments, retirement planning, insurance assessment in a conflict, transparent and an unbiased way. Coming to our exciting webinar today, we have Professor Abhinav Tripathi with us. Professor Abhinav is a faculty of finance at IIM IIT Kanpur. He has an illustrious collection of degrees to his name. He's a PhD from IIM Lucknow. He has done his MBA from IIM Kozhikode and is also a BTech in chemical engineering from IIT Roorkee. He has more than 10 years of experience in financial consulting. He has published in leading journals such as Applied Economics, Financial Research Letters, Journal of Asset Management. So that's about our speaker today. Handing over to Dr. Abhinav, let me, before I hand over to Dr. Abhinav, let me quickly do a quick poll here. So it would be coming on your screen. So please vote. And after that, I'll run that poll for around 15 seconds. So please vote. Okay, so I'll publish the results. Over to you, Dr. Abhinav. Just give me 1 second here. Yes, Dr. Abhinav, it should be, you should be able to share now. You are on mute, Dr. Abhinav. Yeah, okay.
I'm just trying to share my slides. So just give me a second and let me know.
Yeah.
Okay, so is my screen visible?
Yes.
Okay, so thank you, Ankit, and also thank you, Vijit, for giving me this opportunity to present some of my ideas on mutual fund performance. I believe previously some of the practitioners have already given some talks on this platform. So this would be an academician's perspective on a specific topic which I have taken, which is performance of mutual funds. And probably I'll giving you some insights from how we evaluate the performance of mutual funds, what are some of the pitfalls or often made mistakes that we do, and in this fashion we'll start. I believe in intermittently Ankit would be conducting some polls, so that would also be interesting to guide the flow of discussion. So, and I'll keep track of time. If I miss, Ankit may help me in that. So quickly moving ahead, I can start, Ankit, right?
Yes, Dr. Abhinav, just click on that hide link that is coming on your screen so that yes, just click on the hide. Yes, okay, that's perfect. Yeah. Okay.
Okay.
Yeah, over to you. Yeah,
So,
over to you. Yeah.
great. So now, to begin with, I will not again introduce myself, as Ankit has already done. So first, and a very simple thing which all of us know, what is the benefit of mutual funds? That as individuals, there are a lot of instruments, and I'll start with an example of money market mutual funds. Now, generally, the instruments that are traded in money market mutual funds are some of the most liquid, like government securities and those kind of instruments, where as an individual investor, if I wanted to invest, probably I would not have that choice. For example, I would not be able to deal in treasury bills because their ticket sizes are so large. Similarly, if with a limited capital, I want to invest in a large number of securities, given the constraints with individual investment and ticket sizes, it is not possible for me as an individual investor to get the desired securities for me. So this can be easily achieved with a very simple and very powerful instrument, which we call as mutual funds, which is essentially a portfolio of securities. So when we use the word mutual funds for academics, the simple word is portfolio of securities. Why? Because it is a collection of stocks, and leaving the dirty mathematics aside, it can be easily shown with high school mathematics that even with a simple collection of 20 to 30 stocks, you can diversify your risk a lot. So that is the power of mutual funds. Now, this mutual fund is basically run by an AMC. There's a proper structure where there's a sponsor, there's an AMC company, and so on. But put simply, there's a fund manager, which is a set of professionals with a lot of experience who are looking at the industry and running the day-to-day operations of the fund and so on, who are pretty highly skilled people, and this is their bread and butter, their job, and they are highly skilled in this objective, and they manage your money. They collect, they pool the money, they pool all the money from different investors, collect them, and then invest depending upon the sort of appetite and the risk appetite, as well as what kind of investing style a particular investor wants, depending upon the inputs, objectives, and strategies of the ultimate investors, which is you and me. They invest our money in financial markets. The investment securities are across breadth and class of securities, starting from different kind of equity, debt, and so on, and various complex instruments. So this is since it is known to all of us, so I'm not spending much time here. But the idea here is that still, the concept being simple, there are so many varieties that one can slightly get confused across in terms of performance and how to invest them, by and at the same time keeping your expenses minimum. For example, there are a lot of expenses that a mutual fund, the asset management company may incur, running firm, paying salaries, administrative costs, and so on, which are obviously will be charged against your returns only. So these, they will eat up into your profit, and there are other costs as we'll move ahead, we'll see. Now, starting as a objective, uh, at the start of it, probably we would like to know what kind of objectives we have. I guess Ankit may have a poll on this. So what kind of objectives we have when we are investing in mutual funds? And a very obvious answer, first, at a starting point, given a ceteris paribus similar class of instrument, you would like to minimize your fees. What kind of fees they are charging, management fees. Now, we'll come to this point shortly, but a very there are certain fees that are common across funds, which are for administrative costs. There are certain fees which are driven by the way that fund is organized, and we'll come to that part, which is related to more on active and passive mutual funds, where active mutual fund charge a certain fee. I'll come to this in more detail. And also, there is one more difference, which is based on the direct plans and regular plans. So some of us who are investing probably already aware that SEBI classifies mutual funds in two ways, where you can directly, in the same fund also, in a given fund, you can either invest directly connecting with the AMC, or through which is through some platform of exchange, you can directly invest, or there are distributors engaged by the AMC company. Those distributors will sell their plans, but in that case, their commission or salaries of these, what you can say, rather commission would be more appropriate word, their commissions would be charged based on their sales to you, their product sales to you. So it is quite obvious to understand that the effective return that you will get will be net of these costs, which may include these regular plan related expenses pertaining to fund distributors. And therefore, it is there's no gain saying that, given that you are comfortable investing in a fund, it would be more appropriate if you go through a direct manner. The simple mathematics here is that, let's say, and these fees range from as low as 0.2%, which is not exactly very low amount, to even 1% of the overall return. So you can imagine that year on year, if this money is eaten up or getting eroded from the returns, there's a lot of loss of value. For example, a very simple example would be that, let's say you earned a certain 10% return, out of which half percent or 1% was eaten up by this commission to distributor, then you are left with, let's say, 9.5%. Now, subsequent years, the return, the base that will be there for your returns, will be formed by this capital, with this kind of return. Next year, again, same kind of erosion in value. And therefore, if you, over long horizon, if you compare both the strategies, that is between regular plan and direct plan, you would see that the difference is quite substantial. The difference in terms of pie, this pie is quite substantial. Sorry, simply because a lot of your money, a lot in that pizza or pie, a lot of money will be taken up by this commission in the regular plans. So that is one obvious, very obvious thing that you look out for in terms of saving. Second, and slightly on a broader term, you also have certain objectives and strategies. For example, there are different objectives, like you probably want to have more long-term investment, and you are not interested in sort of short-term liquidity. For example, you don't have any short-term need and you are mostly invested in long-term. So that is one kind of objective. What would be second objective? For example, you may want to invest in long term, but also you know that there in short term also maybe six months you have certain requirements, you need some liquidity. So that is there. And third, probably somebody who is more aggressive, looking for higher returns and looking for growth in their portfolio. So that is another kind of strategies. And depending upon your individual risk appetite, different instruments cater to these objectives. And therefore, when you are looking at your objective, it would be good to find those mutual funds where these objectives are met. For example, whenever we look out, if you go to internet and you look for the performing funds, many times you'd find that you will get a list from different websites, different sources, and these websites will simply quote the last 5 year, 1 year kind of returns without regard to the objective of those funds, without regard to the risk of those funds. And let me clarify a little bit more. For example, there are two funds, Fund A and Fund B. Now, Fund B has a mandate to invest in safer assets which are rated AA or above, while Fund B can invest in even not only investment grade assets. When I say investment grade, that means BBB rated or above, and even below low rated like BB or something. So it is quite obvious that on years the return from B would be higher because it is allowed to invest in more riskier assets where returns expectation would be higher as well. And but does it mean that these two are comparable? No, not at all. I cannot compare the performance of A and B because B has that option to invest in lower rated, highly risky instruments which can offer higher returns. But at certain point of time, they may default or sort of not pay, go bankrupt or not pay, and those kind of aspects may also be there. And therefore, it is not wise to compare two instruments or two funds or performance of any two class of securities just because based on their returns. So one important factor is the risk, which we'll shortly come to while assessing the performance. Examining the past performance is good, but considering the fact and whenever what is the horizon? For example, if you take a very lengthy horizon, there is survivorship bias. For example, if you have for example, currently the funds available, those funds, the data is available only for the funds those who have survived. Second, if your horizon is like too short, for example, you take a very short horizon, then in that case, probably the fund, let's say 6 months or 1 year, probably the fund did exceptionally well, but it is no guarantee that it will continue to do well in long term. So you have to, while looking at the past performance, you have to be very careful in a look back window. A good window would be 3 to 5 year kind of performance would be a good window. So to examine the performance of the fund. But that is also important, analyzing the historical returns or historical performance before investing. Now, at this point, a small caveat. For example, somebody may be working like me in a 9 to 6 job, and for us, maybe while going around with our job, it may not be possible to track on monthly and daily basis the performances of different. And there are so many products, so many funds to compare the performance of different vehicles or funds. It's not very feasible while conducting your day-to-day jobs. So you need to rely on somebody who is expert and who can cater to such a needs. For example, whose bread and butter is precisely looking and examining the performance of these instruments. So therein comes the role of investment advisors. There are SEBI registered investment advisors, and I believe this platform precisely caters to that requirement only for people like me and you who probably are have a different business or not exactly directly dealing on day-to-day basis on this kind of aspect of financial securities, and would like to devolve that job in a more safe and secure manner to somebody who is more reliable and has some kind of track record. Now, at this stage, we'll take a slight turn towards investment styles. And this is linked to our earlier part where I said that different mutual funds or investments have different mutual funds and different investments have their own requirement. For example, they can be equity related instruments and they can be debt related instruments. To begin with, let's say you have a lot of growth requirement and you are willing to take that risk, you would probably go into those funds that are more classified as equity. Now, obviously, it's a fund and probably something, let's say, like Nifty 50, where different stocks from different sectors are there, which are able to diversify because they are in different sectors. A case in point, if you, let's say, take all the stocks from the same sector, a fund is taking all the stocks from the, let's say, oil and gas sector like ONGC and so on, probably it's not so well diversified. So a good thing would be to look out for these, and there are a lot of instruments available in across large cap, multi cap, and small cap funds, which invest in different sectors and therefore reasonably diversified, with even as small as a portfolio of 20 to 30 stocks. For some investors, growth may not be as a bigger objective. For them, probably safety, security, and some kind of regular income would be of paramount importance. For those kind of investors, debt instruments are often very useful, because debt, obviously, as while we may not, some of us may not be from finance background, but equity is often considered to be as more riskier than debt, because debt holders have the first claim over the asset, and by that simple logic, generally debt is regarded as more safe and secure instrument, and therefore, and it also offers regular interest payments, so liquidity is also there. So some of us who may be more interested in regular incomes and more say in terms of safety and short-term liquidity, probably we would go into debt instruments, and one class of instruments which is called money market instruments. Money market instruments like treasury bills issued by government of India and various other, like, very short-term commercial papers, who probably are more liquid and slightly relatively more safer, we can invest that. But with the caveat that return offered by these securities may not be as high as equity instruments, and therefore their returns are not directly comparable. Even within, if you look at within equity instruments, you'll find that there are large cap, mid cap, and small cap instruments. Now, worldwide, it is very well established that small stocks, small stocks generally offer higher returns as compared to large stocks. Now, this may, some of us, this may not be a surprise, and some of us, this may be a surprise. A quick answer to this question is that generally small stocks have relatively high degree of risk. There are different risk factors, for example, liquidity, information asymmetry, different risk factors that are accumulated, and relatively at a higher extent they are found in small stocks. And therefore, it has been believed, and the literature has widely documented, that small stocks, they tend to offer higher returns, which is a sort of compensation for that risk, those risk factors only, as compared to large stocks. Now, the crux here, or the takeaway for us, is that over long horizons like 20, 25 years, 15 years, you may find that small stocks are offering, and portfolios that include these small stocks are offering higher returns. And as a strategy, even people employ this as a strategy, that owning small stocks over large horizons like 15, 20 years in general offers higher returns than large stocks. Now, what is the catch here? Can I say that they offer consistently higher returns? No. In between, there will be periods where there'll be high volatility and small stocks will fall in value. Generally, as individuals, for large institutional investors or large organizations, the investment horizons are often very long. But for individuals like us, requirements are there, and our investment horizons may not be as long as 15, 20 years. Sometimes maybe 5 years, sometimes maybe 4 years. Many times we put our money into bank FD, then we tend to do FD of 3 to 5 years. So we do not want to go beyond that, because there's less visibility, and being the vagaries of human life and other issues, we tend to have that penchant for liquidity, and therefore that small stock offering continuous return may, at the year which we want to liquidate, may be very low in value. The idea is that over long horizon it may fluctuate, but give a long value, some value a long horizons, but in short term it may come down. While large stocks, they fluctuate less, they may not offer as high return as the small stock, but still there's less chance of losing money. It is not to suggest that every year on year, small stocks is offering well. So that was small versus large stock, and some portfolio that are invested in equity and debt. The second aspect that I want to discuss is active versus passive. And passive funds are those that try to mimic some kind of benchmark, like Nifty 50. So an ETF or some kind of mutual fund which is tracking Nifty 50, its performance will be evaluated how close it is to Nifty 50. So its performance measure is simply what we call an error ET or delta T, which is nothing but the difference between Nifty 50 and my portfolio performance. This is the error measure which we track and see how big or small this error is. Pretty simple. As compared to this active funds are slightly different in the sense that they claim to make superior returns. And they say that we actively buy and sell, participate in market. So as to time, there are two aspects to this active participation. One is timing. I'll come to these in more detail, timing and selectivity. and they actively participate in the market to offer higher returns as compared to the benchmark. What is the benchmark? The benchmark is an instrument, any instrument which is of similar risk to this active fund. So the active fund will select a benchmark. The benchmark should have same risk as that of active fund. And then these active fund managers would actively participate in the market by timing and selection. The idea is that on account of their higher performance and skill in the market, they demand a certain higher active management fees. This active management fees is not there with the passive funds. So that also makes a fundamental difference in overall fund returns. And second, because of their continuous buying and selling, there are transaction costs which put additional burden on the returns. They eat up into your profits. So that is the second aspect of it. Now, the last bit is value versus growth. Coming to value versus growth generally relies on two aspects. One is price to earning ratio, which is very important ratio in financial markets. The value funds look at the numerator, that is P price. There are times when market takes a cautious view of certain securities, and therefore certain securities are depressed at time. The reason may be anything, maybe CEO resigned, maybe there was a fire or theft in a factory and so on. So there are certain securities that are undervalued. So these stocks are called value stocks because there's nothing fundamentally wrong, but still they are selling at cheap prices because market has taken a cautious view of them. While talking about growth stocks, you tend to look at this earning component. These growth stocks are not necessarily cheap. They may be technology stocks like Apple, Google, Microsoft, and so on. They are not necessarily cheap. In fact, they are costly. If you compare their peers as compared to their peers, they may appear costly as well. But it may be the case that their earnings, their expectation of earnings is pretty high. So if you look at their expected earnings, they would be pretty aggressive, which results in investor willing to pay a higher premium for them. So this is value versus growth. Generally, it has been believed that if you look at the performance of value versus growth over long horizons like 15 to 20 years, value stocks perform better than growth stocks. So a portfolio which follows this value style may be performing better than growth style. Now, at this stage, I would like to show one performance matrix here. So how do
Professor Abhinav, actually we are running late, so I would appreciate if we
I'm just
can
concluding.
go there.
Just conclude.
Yeah. Okay. Yeah. Thank you.
So just to conclude the performance matrix, you would want to know what is the mutual fund style uh, or the investing style of a fund manager, and you would like to compare him with only his peers who have taken similar kind of risk or investing in similar styles. So a simple way is to construct a performance matrix. Generally, this is what performance evaluators would do. So let's say you have two dimensions. One is value versus growth dimension. So let's say this is value and this is growth, and the other is size dimension. So you start from large cap to small cap. In between you have mid cap, and here you have a blend of value versus growth. So you create these square matrix of performance, and every bucket here would involve a certain set of portfolio managers. For example, this would be somebody who is in small cap stocks and value, or in contrast, this would be somebody in large cap stocks and growth. Now the performance of those fund managers or those funds that fall into the same bucket can be compared with more reliability. So that is how you compare the performance. And just in closing, as I noted, one important aspect of this is of any fund is its expense ratio. So while looking at a fund to invest, you probably, and this data is publicly available on MFI website, which is a collection of all mutual funds. You can look at their historical expense ratios to examine their cost. And another component is you probably may like to invest directly rather than using regular plans so that your transaction costs are less. So broadly, this is the overall topic, and probably we would, if some future opportunity, will cover some more ground. So this will be, and in that, to summarize, probably you would do well to take advices from people who use this or who are part of this industry as their bread and butter. They regularly monitor the performance of funds and so on, and we can leverage their expertise. So that would be better rather than burning your hands in the first attempt. So that would be more desirable. So that would be, in the interest of time, I would be, because I've already overspilled by some minutes. So probably would be better to close from my end.
Yeah, thanks, Dr. Abhinav. Thank you for wrapping it within time. I think we didn't touch upon one of the key parameters there, that is a Sharpe ratio. So could you throw some light on that as well?
Thank you,
Yeah,
Ankit. So this was
yeah,
a very important aspect of our presentation where you would want to compare. So for example, you would want to prefer a stock where which or fund which offers you the highest bang for the buck. That means for a given amount of risk, it offers you the highest return. Now, the formula of Sharpe ratio is pretty simple, but I need to elaborate it more on it. The formula says that let's say you have a asset or fund RA bar, the return on fund, and RF is the risk-free rate. Sigma A is the overall risk. Sigma A is the standard deviation in mathematical terms, but it is the risk of the portfolio A. Now, think of in simple terms, let's say you are buying a commodity or a vegetable. There are the overall price that you pay is the price of the vegetable. It may be in some quantity into overall quantity of the vegetable. Similarly, for an instrument, you would like to know the return based on what is the price of risk I'm paying, price of risk into quantity of risk. So this measure, Sharpe ratio, offers you that price of risk, how much price of risk an instrument is offering, which is numerator is essentially RA bar minus RF, which is the excess return over risk-free rate, which is your risk premium, excess return that you are earning, and denominator sigma A or standard deviation, which is the risk part of it. So it is the return per unit of risk, and it is a measure that a given instrument how efficient it is in offering you return for a given amount of risk. So this measure is very often employed in comparing the performances. You tend to pick those stocks which offer you this high price for a given amount of risk, and then it is up to you how much the quantum of risk, how much risk you want to take, but and how much amount you want to invest in that. So this is your Sharpe ratio. It has slightly more mathematical lineage, but for now, in the interest of time, I'll skip that.
yeah. So we have one more poll that will float, and post that we will open for question and answer. Okay. So the last poll here is yeah, this one. So please vote, and I'll run this for 15 seconds, and post that will open the floor for question and answer.
In the meanwhile, I can cover two aspects. One is on timing and one is on
Yes,
selection. Just
yes, sure,
so,
Dr. Abhinav,
so
please go ahead.
often
Yeah.
these fund managers, particularly the active fund managers, they take a bet on market. Now you would expect the market to rise or fall. These fund managers, they feel that if they are good and efficient in their predictions, if they believe that market is going to rise, they tend to increase the risk of their they tend to increase what we call the sensitivity of their portfolio to market, which is often, we probably would have heard this term beta, which is the sensitivity of stock to market. They tend to increase more high beta stocks or more equity in their portfolio. By adding more equity, they increase the beta of their portfolio. So if their anticipation or bet is right, market will increase in performance. While at the same time, if market they anticipate the market to go down, they want to decrease the beta and they move towards more debt like securities. So they decrease the beta. And if their bets are correct, their performance is relative to better than market. Now we while it is good that they made return, but their bets can go wrong as well, and in that case the investors may perform the investments may perform not so well, and therefore there's a risk involved. So if they perform well, there's not very excessive credit that should be given to them, in the sense that they have taken a risky bet, and therefore if that bet is successful, they did well. If not, they did not so well. But should not be mistakenly given that they have done some kind of fundamental analysis and there's a fundamental thing that they have found.
Okay. Yeah, thank you for sharing this, Dr. Abhinav. With this, we open the floor for question and answer. So, thank you once again, Dr. Abhinav. And dear attendees, we are running late by a few minutes, so we will take few questions. So please, if you have any questions, please put them in the comment box. So there is one question by Mr. Debajyoti Sarkar. At present, my ELSS funds are performing really well. should I keep on investing with them or switch funds? So, Dr. Abhinav, do you want to say something on this?
If it is performing well, then it is fine. So unless until, so generally, whatever from academic perspective, what I would like to say that we as a retail, if you are a retail investor not actively involved in this fund and securities, rather not take too many bets on different riskier instruments. If you find, if I found something which is doing well over long term consistently, then better stick to that. I believe if it has done well, probably they would have already invested in broad market securities, and they have diversified most of the idiosyncratic and stock specific risk. Therefore, if it is doing well, just, but if it has done well over a long period of time, 3 to 5 years, not like a year or so. So if you're reasonable for reasonable horizon, 3 to 5 years, they have done well, then you can stick to them and just see the constituents of the securities. Are they these are reliable stocks like who have good history of performance? Then there's nothing wrong with sticking to the current portfolio. And also, there's one more thing which may just we need to explore more, but it has more recent the change in tax structure. So you would obviously be getting somewhere around 40,000-50,000 of tax benefits on your ELSS investment that you are regularly doing. So how that is impacted by your shifting, if you want to shift to new tax regime, generally it is more advisable for young people who may not like to make any much investments or like housing loans and so on. So if you are planning to shift, then that extra benefit, if you are you losing that benefit, that also needs to explore the impact of your switch to new tax regime. So that one factor you may consider in your investment into ELSS.
Another question that we have is okay. Thank you for answering that question. Another question that we have is that okay, other than Sharpe ratio, do we have other parameters to evaluate these funds? And another thing is that okay, is Sharpe ratio can be used for everything, or should it be only restricted to some kind of mutual funds like that?
So broadly, there are more advanced mathematical parameters, but as a thumb rule, the idea is to see whether your portfolio is well diversified or not. So for example, if your portfolio is well diversified, then you tend to use something like Sharpe ratio. And sorry, just let me share the, can I share the slide?
Yeah, sure. Please go ahead.
I just wanted to answer this question in more detail, but somehow when I don't know if my slides are visible. Are they visible?
Yes, they are visible. Yeah.
Okay, so what I was trying to say is that look at, there are two broad risk measures, and if you look at any fund or any security, there are two components to risk. One is called market risk, which is driven by market. Another is called idiosyncratic risk, which is driven by individual stock specific aspects. Now, if your portfolio, if you believe your portfolio is so well diversified that the only factor affecting is market, so then instead of this sigma A, which is a measure of total risk, sigma A measures the total risk, which includes the market risk as well as idiosyncratic risk. You probably want to use beta as your performance measure, and then in that case, this is called Trenner's measure, which instead of sigma uses beta in the denominator. The idea is that you believe that your fund is so diversified that the only factor affecting its the only risk factor is the market, and therefore beta is the appropriate measure. So there you use Trenner's measure, which is nothing but RA bar minus RF, but in denominator we use beta. In contrast, when we were using Sharpe, we were considering the total risk of the portfolio, which probably was a less well diversified portfolio. In the interest of time, I just quickly go through one more measure, which is called Jensen's alpha, and it works like this: RA minus RF, RA bar minus RF equal to alpha plus beta times RA minus RF. This is more appropriate for active fund managers who would like to give you some extra alpha by actively managing or buying and selling of securities. They claim to generate higher returns than the matching risk securities. What is the risk here? Beta. So they claim to generate higher returns as compared to securities with the risk of beta, and that extra return that they claim to generate is alpha. So this alpha is a measure of that. Jensen's alpha is the measure of that active fund performance. Are they able to generate this alpha consistently over long horizons or not? So there are similarly, the complexity will increase as we consider more and more risk factors. As of now, we have only considered market as a risk factor. There may be industry and various other risk factors as well.
Okay, thank you for answering that question, Dr. Abhinav. Another question that we have is, so that will be the last question, I would say, because we are running over time. Like, what are the tools retail investors can use for evaluating these funds? Are there any tools available?
So if you, there are various easily available tools. For example, I tend to use some like R, and you can use R, Python, or even simple Excel to find the performance of your funds. Now you need not be any programmer or anything. Simply use any kind of calculator or Excel and calculate the following measures. Like we did Shape, then you use Jensen. Jensen is RA minus RF upon beta. So these two measures, you can see how they have performed over the last 3 to 5 years. And if you find that your fund is offering you for a given amount of risk, offering you excess return, then you tend to believe that, okay, they are doing well. But also at the same time, keep in mind, what is the, compare them only with their peers. For example, one fund is in large cap, other fund is in small cap. Don't compare them. Compare only those who are operating in large cap or small cap. Or let's say you have an objective into balance fund, then only compare funds with similar same objectives, and then you can use these measures. If you're comparing funds across different objectives on this performance measure, your results may be inaccurate. And most obvious mistake that we do, we look at absolute returns to compare performance. That is a strict no-no.
Okay, thank you, Dr. Abhinav. With this, we come to the end of the webinar, and I am really thankful for sharing so much insights. It was really helpful. I hope the same was the case for a lot of our attendees. They got valuable insights about investments and investing into mutual funds, what things to look into when selecting a fund. So really helpful. And thank you for being a wonderful audience, dear all attendees. And we look forward to seeing you again in our next webinar.